Welcome. I'm Thorsten Beck. I'm the director of the Florence School of Banking and Finance, and I would very much like to welcome you to the second lecture in our Women in Finance series. We have a very diverse audience today. Many among of you are not here for the first time, but we also have several people in the audience, or quite a large share of the audience, which is with us for the first time. I can also see from the registration that we have a very geographically diverse audience, ranging all the way from Argentina, Brazil, to Singapore and the Philippines, and of course, with many countries in between, especially Europe. Many from academia, but also international institutions, national authorities, European institutions, and NGOs. And according to our registration, 77% of our audience, or the registered audience, are female, which is also very much what we were hoping for. I want to give a short introduction into the Florence School of Banking and Finance before I give over to Elena and Anna. We were established 5 years ago as part of the Robert Schuman Center for Advanced Studies in the European University Institute as a platform to bring together practitioners and academics from the banking and finance sector. What we do is offer both training courses and online seminars. So this is one of our many online seminars that we have. We have one about every 2 weeks, not during the summer though. We are having a European tradition of not having much during the summer. But we have lots of different training programs, and they are, of course, given current circumstances, all online, although we hope to go back to residential shortly. So for example, just to tell you a bit about our offer, we have a fintech course coming up in September, a panel data course, which is more on the technical side. We're going to have a course on macroprudential policy, a course on securitization, and, which I don't show here on the slides, we have a course on banking analysis for sustainable finance. That's actually residential, and a course on cross-border supervisory cooperation. So again, welcome to the FBF. And one of the initiatives that we introduced this year is the Women in Finance initiative. And which basically, I mean, we're not the only one to come up with these ideas, but our focus is to both focus on topics that are relevant in terms of gender dimensions in finance and economics. And today is a very good example of that, while at the same time also featuring successful women in politics, academia, private sector, and so on. And again, today we have a prime example for this with Annamaria Lusardi. Now, who better to chair and to lead this initiative than my predecessor, Elena Carletti, professor at Bocconi University, and I will now give over to her to introduce, again, the initiative and the speaker. Thank you.
Thank you very much, Thorsten, and good afternoon also from my side, and welcome to you all to today's lecture, which is entitled Gender Differences in Financial Literacy, and is given by our speaker, Professor Annamaria Lusardi. As Thorsten said, the event is the second one in our Women in Finance series. The series started the last April with Commissioner McGuinness. I am delighted to chair the lecture today, and I'm very happy to welcome Annamaria to our school. I've actually wanted to get to know her for a while already now. We have been also collaborating in the context of the European Finance Association Conference, and finally I have the occasion at least to see her virtually, and I hear she is actually in Piacenza, so not far from Milano, where I'm located right now. So Professor Lusardi is a university professor of economics and accountancy at the George Washington University School of Business, where she also the founder and director of the Global Financial Literacy Excellence Center. So we really think on the topic, we can't get a better speaker than Annamaria. And previous to that, she was the Joel and the Susan Hyatt Professor of Economics at Dartmouth College, where she was for 20 years. So the topic of today, as we already mentioned, is very close to the spirit of our new series, Women in Finance, as it will touch upon a very important topic, which also goes a little bit in the spirit of FPF, wish to extend beyond Europe and also touching more the emerging economies, if I may, because the topic is very much financial literacy, and in particular, the gap between women and men in this field. Is this a reflection of lack of knowledge, lack of information, or there is something that is more related to a lack of confidence? And I'm really looking forward to hearing what the result of the study of Annamaria is, and also to see what policies we can put in place to try to fill this gap. Before giving the floor to Anna, let me mention some housekeeping remarks. We will start with the speech by our speaker, and we will then open the floor for discussion. And in the discussion, we will talk about financial literacy and gap men and women, but in the spirit of our initiative, we would also slightly enlarge the discussion on the difficulties that women may have in finance more generally, in pursuing careers in this sector. We have already collected lots of questions through our registration procedure. We will try to reply to all of them, but please, I ask the audience to keep asking questions using the Q&A box, and also clarifying questions during the talk. And I will stop at some point asking for clarifying questions. And now, without further ado, please, Anna, the floor is yours. And thank you so much again for being with us today. Please.
Thank you very much, Elena and Thorsten. I'm really delighted to be here and present this research today. Let me actually share my slides, so it's going to be easier to do the presentation. And I hope you can see the slide. So this is a project I started many years ago, and it is a collaboration with many authors. I'm just so delighted to be invited to this special session of Women in Finance, as I think this is a very important topic, and the data as well talks about the importance of women in finance, as I will be more specific in a moment. As I mentioned, what I'd like to do, rather than presenting a specific paper, to talk about this research project that I've been doing for many, many years, and in particular focus on one particular topic, which is this gender gap in financial literacy, to show you how pervasive it is, and then to try to address why do we see this gender gap, what are some of the determinants, most importantly, does it matter? And also, given also the questions that you sent to me, I also would like to address some of the solutions that the data pointed us to. So the presentation is really divided in different parts, and I'll try to stop at each of the parts if there are clarification questions, and leave a lot of room at the end for questions as well. So let me just start with measurement. Measurement is very important, because if we don't measure, we won't be able often to address the questions, to address a problem. And so you might know, and you might have seen what are called the big three questions. And these are actually three simple questions that Olivia Mitchell and I designed several years ago to measure financial literacy. And the reason why we designed these questions is because there weren't really a measurement of financial literacy up to then. And we wanted to figure out, but how much do people know? And as you can imagine, it's very hard to design financial literacy questions, because, what do you ask when you want to see how much people know? And why did we come up only with three? So let me start with that and say that, this was a constraint imposed to us when we were trying to put financial literacy question in national surveys. And what they told us is, first of all, there was a lot of resistance in adding new questions, and in particular, a lot of resistance in this particular topic. And so we were given only three questions to add. And what we thought was a major constraint turned out to be a major asset, actually, because since there are only three, it was then possible to add them to many, many surveys. I want to start showing these three questions. I won't spend a lot of time, because I'm sure that many of you might know them. But what we did when we designed this question, we look at the simplest and most fundamental concept at the basis of every financial decision making, meaning interest compounding, inflation, and risk and risk diversification. How we came up with this specific wording has to do with the fact that these questions were designed for the general populations, and so they had to be as simple as possible. As you can see, the first question is not even about interest compounding. It's really a simple questions about numeracy, the capacity to do simple calculation in the context of interest rate. The second question is about inflation, and this is where we try to be a little bit more sophisticated, but we ask a question in the context of the many decisions that people make, or using the language that you would find if you were to read a newspaper. The third question is the most difficult one, and it is designed to be difficult because we needed to differentiate among different levels of financial knowledge. So, three simple questions looking at fundamental concept. And I just want to mention something about the methodology, that we don't ask people to do calculation in their head. We don't ask them to tell us what the right answer is. We list a set of answers. So we ask people to choose, with the possibility to also say, I do not know, because we don't want people to choose at random. So this is what we did, and I have to say this is more than 15 years ago. We were able to ask these questions in many national surveys, and actually we coordinated eventually with as many as 15 other countries. Actually, this is a lot more now. We have added financial literacy, what have become known as Big Three, in many surveys around the world, and we have been able to also do special issues of several journals where we compare the evidence precisely on these Big Three across many countries. And this is why we now can talk about gender differences, because when you look at so many countries, something emerged very, very quickly. And what emerged is this gender difference in financial literacy. So what I'm going to do next is show you some of the evidence, and I've chosen 4 countries, just because, as you'll see in a moment, the findings are very, very similar across countries. So let me start with the US. This is the first country where we were able to add questions to national surveys. And I'm going to choose the data of the regulator. This is the data from the National Financial Capability Study, which is done by FINRA, Investor Education Foundation, which is the regulator of the financial markets. And it's a very large data set. And we are talking about actually data in 2009. But when you look at the most recent data, 2018, the findings are very, very similar. And the first thing I wanted you to see is that even when we look at extremely simple questions, in fact, many people cannot answer these simple questions. And as you can see, also the question that people find most difficult is the third one. But the most important part for this paper is just to show how many do not know we have in this data. And in particular, that the proportion of do not know increases disproportionately to the questions about risk diversification, where about 1/3 of people say, I don't even know the answer to these questions. How do we measure financial literacy? Simply, we sum up the number of correct answers. And as you can see, the most striking potentially result, certainly was striking when we first presented it, is that even when confronted with very simple questions, and just 3, in fact, only 30% of Americans, this is the country with the most sophisticated financial markets, can answer these 3 questions correctly. If you look at even the 2 simplest one, the first 2 questions, half of Americans are able to answer those questions. Let me show you the evidence from the other country, and you'll see why comparing data across country is so important. So when you look at Canada, the interesting thing is that the result, the pattern are very, very similar. So yet again, we see that the difficult question is there is diversification, and there 1/3 of people are not able to answer this question. They say do not know. When we look at the proportion of correct answer, again, not even half of the population can answer these three questions. Let me turn to Europe, and I've chosen Germany in particular because the data set that I'm going to use next is actually the Netherlands. And so, we have seen that overall Germany and the Netherlands have very specific and similar characteristics, but here as well, same patterns. Perhaps people in Germany know more about the inflation and they can do more simple calculations, but the same pattern yet again, and yet again, about half of the population only can answer these questions. And the Netherlands is important to us because this is the countries where working with the central bank in particular, we have been able to design a lot of questions, do a lot of work, and in particular do the project that I'm going to explain in a moment. But that yet again, what you see is the same result. Only half of the population can answer the risk diversification question, and 1/3 says, I do not know. And again, less than half of the population overall can answer these three simple questions. So the first result I would like to highlight is exactly this one, which is that overall we find extremely low level of financial literacy. This is surprising if you think about this, given that we are facing with such complex decision, and yet half of the population can hardly answer relatively simple questions. But let me turn now to a group that is very important. So let's compare men and women. And as you can see, and this is true not only for those 4 countries, but I wanted to show you that no matter in fact which country you look at, there is a gender difference in financial literacy. When it comes to these questions, even these 3 simple questions, women know less than men. And these differences are important and statistically significant, and in some cases the gender gap is quite high. Interestingly, and if you follow some of our work, we have done a survey globally using more than 140 countries, and more or less there is a gender difference in financial literacy everywhere. So there is truly something about women and questions, financial literacy questions, that seem to show that women, when it comes to this topic, know less than men. But is it because they answer incorrectly to these questions? Well, let me show you that what happened is women disproportionately tend to choose the do not know answer. And this is also true across countries. I'm sure that if you are a teacher or a professor, you probably are familiar with this topic, that if you ask a question to your class, often the many hands that go up are not your female student, but are your male students. However, if you then probe the female student and ask them to answer the questions, they are actually able to do so. They just weren't sure 100%. And this is what we thought as well. We wanted to investigate, but are these do not know really lack of knowledge, or does it mean that women are not 100% correct, but in fact they know a little bit? They just didn't want to venture in answering these questions. So we have written a paper about this, but then we got to the data and we wanted to understand a lot more about this gender difference in financial literacy. So what we did, actually via the help of the central bank in the Netherlands, we were able to do the following experiment. If you think about this, we actually use a trick. We asked these 3 questions as we did now, and then several months later, so we had the first survey in May 2012, and then in June, what we did, we took away the do not know option. And so we asked everybody to answer these questions. So they were forced to pick an answer. And then we asked, how confident are you on the answer? Okay, so let me tell you what happens when we do so. So we have a sample of a panel sample. So we are able to follow precisely the same individual over time. We have some attrition, but that attrition is not responsible for this, the result I'm going to show you. Neither we find evidence of learning really that makes our finding different. So let me jump right away and show you what we find. Here are the two answers in the April and the June, in the May and in the June. And what you can see is that when we took away the do not know options, women and men as well are more likely to answer correctly these questions. You know, for women also the proportion of the incorrect answer increases overall, but as you can see, the proportion of correct answer goes up in the June survey. This is also true about inflation. So when we ask people, again, force them, push them to answer these questions, in fact, we do see a high proportion of correct answer. And, for women as well, there is this higher proportion. And we also see that women are more likely than men to be incorrect, but the proportion of incorrect answer is not very high, but is certainly higher than men. But yet again, we see that, in fact, women seem to know, but perhaps they weren't willing to answer this question, or they weren't quite sure. Remember, the risk diversification is the one with the higher proportion of do not know. And what happens when we do that? As you can see now, the number are much, much higher, right? So the proportion of correct answer goes up for men, but much more also for women. Yet, yes, there are higher proportion of do not know of incorrect answer, but certainly women know a lot more about risk diversification than they told us in the May survey. And in many cases, they were correct, okay? But what happened if we if we look at their proportion of correct answer, and also if we look at, what is their pattern of answering? As you can see here, women were a lot more correct, even when they said do not know. In fact, there are a lot of correct answer later on in May, in the later questions. If we look though at their confidence, and here is already what I was trying to point out, and what will be, in a sense, the answer to our question, what is it that generates some of this gender gap? Well, we see a much different confidence. So even when women were correct, and this is in the May survey, and we look at their answer later on in the June survey, they tend to be less confident than men. As you can see, men tend to be very confident and choose the, number 7. This is the highest level of confidence. But even when women are correct, they are not very confident. When they do not know, they certainly are not confident in their answer, and not as confident as the men as well. Okay? So we realize that, confidence does play a role in some of these questions, and in particular, when we look at potentially more sophisticated concept. Also know that in some of our concepts, we have added a lot of jargon, right? So the third question about risk diversification is a joint test of whether you know this topic, and also whether you know the specific concept I'm talking about. What is a stock mutual funds, and so on. Okay, here now we have two pieces of information, and as you can imagine, both of these questions measure things differently, right? So the first measure, the May measure, is affected by confidence. So we don't, we have a mixture of knowledge and confidence, okay? In the July measure, what we see, we took away the confidence, but potentially we have also measurement error because we are asking people to really give us the answer, even though they are not sure 100%. Okay, so what we, in a sense, can say that, the indicator that we are using so far, summing the correct answer, is not a correct indicator, if you think about this. In the May measure, we get, we are giving 0 often to people who do know. They are not sure 100%. But if they are not sure 100% and they tell us do not know, we give them a weight of 0. Okay. In the July measure, instead, we force them to answer. And so sometimes this correct answer we get, we have given a weight of 1, is not correct, because in fact, they were uncertain about the answer and some might just be at random. Okay. So in other words, what we need to do is now construct a different indicator. In other words, give weights differently. And this is actually what we do in this model, in this latent variable model. I do not have time to explain it to you, but basically to give you the specific detail. But what I wanted to just give you is this formula, which is that what we are trying to do is now calculate the proper weight of this answer, given that people are not, confident that women and men difference in their confidence, and therefore, often they don't give us the right answer because they are not 100% confident. So what we want to do is construct an indicator that weighted each questions by the probability of being correct. In other words, we want to infer, right, how much knowledgeable you are, given that sometimes you are uncertain about your answer. You are not 100% confident, but if you are 80% confident, we want to give you some weight for you to, have some knowledge. And this is actually what this latent variable model really does. So we can calculate now this indicator differently and giving different weight, not this very crude 0-1 weight as we have done so far. Okay, so let me show you then what we get by doing so. And as you might expect, we are probably expecting something in the middle, right, of this. As you can see here, you're normally in the May measure, we have, perhaps not a high enough measure of correct answer, because again, if you're not correct, people are not willing to do so. And in fact, the number is pretty low. It's very high in July, but perhaps, too high. And in fact, what we think correct measure is actually 87%. Okay, so we have an indicator now, which is very much in the middle of those two. These are in a sense the boundaries. And, overall, we can see that people, yes, overall are able to do this simple calculation. When it comes to inflation, actually, the proportion is about 86%, not this 85 or not this 91 that we see in the data doing this very crude weighting. But the most important one is the risk diversification, where now we found that, yes, it is a difficult question. And, the correct answer here, or like the best weighted answer, is about 63%. Okay, so we are actually better able to calculate how much financially literate are. And by the way, you have probably already seen it in the graph I showed you before, there is indeed a gender difference in financial literacy, and it still remains even when we now can calculate this measure properly, taking into account confidence. If you remember, women were more likely to be incorrect than men, okay? But by this calculation, now we can at least see how much it is knowledge and how much it is confidence. right? By comparing the main measure versus the true financial literacy, which basically, cleans out from the confidence effect, we can more or less now calculate that the gender difference in financial literacy is about due. In fact, 1/3 of this gender gap is due to confidence. So these simple calculations allow us to disentangle how much is knowledge and how much is confidence. Okay, and so this is in a sense a step forward toward measuring and understanding better what we see in the data. Now, let me turn to a very important question, which is, but does it matter? Does it matter that women have lower financial literacy? And does it matter also that their confidence is different? What we decided to do is examine the stock market participation. So we have data in the Dutch Central Panel data of whether people own stock or stock mutual funds. And so we are looking simply at that. And it is because participating in the stock market, buying stocks, is what is quintessential consider finance, much more than any other decision. Okay, and I want to show you that the measure that you use of your financial literacy really matters in terms of the estimate you get. Okay, so in particular, what we do see, these two estimates, how much financial literacy matter and the gender gap in how men and women participate to the financial market, come up with different estimates. In the main measure, where we have both knowledge and confidence, right? In this measure, what we see is we get a very large parameter, much larger than when we look at the true financial literacy, which has already been able to take out, in a sense, the confidence measure. And what you also see is that here there is a lower estimate for gender, because a lot of the confidence is actually in the financial literacy measure. And instead here, the gender becomes much higher because now confidence is not picked up in this coefficient, but is going to be reflected in the gender coefficient. So it is important to have a good measure of financial literacy, in a sense, what is true financial literacy and not other feature, because when you look at how much financial literacy matter, you can answer this question much more properly. And what you can see here as well is that not just knowledge matter, but there is a gender difference in financial literacy in participating in the stock market beyond, in a sense, knowledge. And we think that part of that is also attributed to confidence. In other words, that both knowledge and confidence matter in the participation of the financial markets. Also, you might think, well, but financial literacy is not a gene. It is a variable which is potentially endogenous. And so if we take into account the endogeneity, and this is really for the econometrician here listening to us, I wanted to show that we can also do a GMM estimation, an instrumental variable estimation, and consistent with our story that you have a much, in a sense, a measure much more affected by measurement error in July. It's much harder to find good instrument with the July measure. Instead, it's easier because we have both the confidence and the knowledge in those measures, and so it's easier to predict it both in the May and in our true financial literacy coefficient. And you can see yet again, even in the instrumental variable estimation, is that financial literacy is a very important predictor of whether or not you participate in the stock market. And remember, this is not a variable that has considered a lot in the past. Okay. In our model, we are also able to estimate underconfidence. So we want to see, does underconfidence matter? The fact that, as you can see, women have lower confidence than men. So this is really what we are trying to capture. And it does matter Underconfidence is an important predictor of the financial market. In other words, if you are underconfident, you are less likely to participate in the financial market. And as you can see, because we measure confidence or better underconfidence, the gender coefficient is different and the financial literacy coefficient is different as well. So in other words, it's really important to disentangle what is what, so you can give a proper weight and you can give a proper interpretation and a proper estimate of what you found. So, but now you can tell me, well, but I don't have the capacity to, first of all, add financial literacy to national survey, let alone, do this experiment myself in other countries. So what we can tell you is, there is a trick, or there is a way in which you can use our estimate. So you don't need, in a sense, to do the experiment we did. You don't need to answer these two questions twice. And also you don't need to use this very complex estimator. What we have found is that if you use our big three, you can actually use the simple measure that we have done. So sum up the correct answer, but also sum up the do not know and use the do not know as well. Add that information to your regression. In other words, the do not know are going to be a proxy for confidence. And interestingly, and so we had to show this empirically, adding the do not know is going to give you an estimate which is very similar to the measure of true financial knowledge, the one that we had. And you're going to have a measure, in a sense, that is not as affected by this confidence, because you are proxying for confidence with the do not know answer. And the coefficient of gender as well is going to be a lot more precise. So, we have done, in a sense, a lot of work to try to show you that you need to take into serious consideration the do not know answer. The do not know answer provides a lot of information. So add that information in your regression and really use it. Let me go, therefore, now very quickly to say, so what do we find in this paper? We find that the gender gap in financial literacy, at least part of it, can be explained by this gender gap in confidence. Women are less confident than men when it comes to finance. And not only we need to acknowledge this and document it, but the most important thing is that it matters. It influences behavior. Because women are less confident, they are less likely to participate in the stock market. And so, that's why we have used this also statue of the fearless girl, or we call this fearless woman, is because in the US, this was something that the financial industry had also perceived. And several years ago, a statue of fearless girl was put in front of the raging bull in Wall Street. And we think that that's very appropriate. It is indeed, what we need, because, women do not have that type of confidence. And the stock market is an important market where we do see women are not participating. And let me just say that this is particularly important if you think that not participating in the stock market is a sideshow. It's not the case. We have a paper in the JPE that actually shows that financial literacy enable people, for example, to invest in more sophisticated assets like stocks, and document that as much as 30% of the wealth inequality at retirement is accounted for by differences in financial literacy. So not participating in the stock market is going to make women less likely to accumulate wealth and less likely to be financially secure throughout their life. So what to do? I want to go through a couple of suggestions and then leave the room for questions. I do think that to address this problem, we need to have financial literacy in school. start it as early as possible. In fact, we need to start speaking to women about finance as early as possible. We need also to have financial literacy program in the workplace, because at work, this is where people are, but they have to be targeted, I think, to women. And we need to also change culture around this topic, because make sure that women don't perceive this as a business for men. And I think this is where the role model can be very important, but also where fearless girl can indeed be important. You know, this touches as a meaning, and I do think that we need a local fearless girl in every country around the world. This is not just the US. We published a paper recently looking at data about 15 years old. And because we are in Italy, I have to tell you that Italy, unfortunately, has a bad record when it comes to financial literacy. It's the only countries where we see a gender difference in financial literacy already among 15 years old. So these gender differences and this probably gender in confidence starts very early. And this is why we need to have it in the school, because this is where women together with men can actually learn it. Otherwise, they can be left behind. I've started teaching personal finance at GW since 2013. And my course has been very influenced, for example, by this research, and I've incorporated all of the findings of the research in teaching this course and try to teach it better. We have also designed financial wellness program for the workplace, and using our research in particular to target women more and to have program better targeted to them. And more recently, 3 years ago, I was elected director of this new financial education committee in Italy, which is in charge of designing a national strategy for financial literacy. Let me just tell you that a lot of our initiatives, because of research and data, are targeted to women. And more recently, in the new 3-year plan, we have designed women as the main target of the committee work. Because in Italy in particular, we have a very, very large gender gap, and therefore a much harder work to do. This difference and this initiative actually do make a difference. I wanted to tell you about a statement that this little girl made during Global Money Week that was launched last March. So we have exposed, we have done for 1 week financial education program exactly to young people. And I love the word of this kind of girl who says, what is it I want to learn? I want to learn about money, how to invest it. And this is just to show that we do need to encourage girls and women, and that Fearless Girl is another great way to do so. But in general, I think, and let me stop sharing, I think we need to encourage role model. And so I didn't want to downplay you, Torsten, but the fact that, for example, we have a woman, Elena Carletti now, for example, heading all of this initiative in Europe, for example, at the European Banking Association and so on, I think really plays an important role. You know, we have downplayed the role of women in finance, but I think if we want to make progress, we need to put women in there to make sure that women can aspire to do this job. Women can aspire to invest in the stock market and can aspire to work in the fields of finance. Is not a field for men only. Thank you very much.
Indeed, yes.
Thank you very much, Anna, for this fascinating talk. I really was eager to hear each single word that you said, because it was really super interesting. Let me ask you some questions that came during your talk, and also reminiscent of another paper that I listened many years ago when I was actually a professor at the UI. So first, women are less confident than men. This is your your overall conclusion. But then, as Bernard Casey says, yes, but however, we also know from many studies that financially confident people make less good judgment. But that somehow, it seems to me that when you look at the second part of your talk and you say, yes, but they invest less in the stock market, and therefore also, I mean, wealth-wise, the gap increases because of that. It seems to me that indeed, the fact that they're less confident also makes them participate less and also make, in a way, worse judgment. So the link between confidence and the quality of judgment, how do you see it? And then related to this, Joanna Breuer then asked, but this issue that when you are confident, it depends then on the judgment you make, and then your finding may not be linked also to the decision making under competition. So when women are compared to men, and the topic is stereotypically male, and therefore that is why women are confident. Or in other words, is the lower confidence of women, you think, a general feature of women, or is it related to a field like finance and money that is indeed the stereotype, as a stereotype male?
There are two great questions. So first of all, you know, that's why you need empirical work, right? So because you might think, you know, and when I saw that women are saying do not know, we can say that's a good answer, right? Because if you don't know, why don't you say that? Right? I mean, you know, so having overconfidence is also a problem. But I think there is a point of, you know, and this is where the fearless girl come in, where, you know, the confidence can prevent you from acting, can prevent you from taking action. So this is why, you know, there is a point in which being cautious becomes being fearful. And so, you know, we are moving from the, you know, being cautious and being wise to fearfulness. And I think that's what happens to women. In other words, they are too afraid. And therefore they don't act. And this is, I think, what the data is telling us. The data is telling us that, you know, women are less likely to participate in the stock market. And you might say, well, but that's good, because if you participate, you're not doing well. That's actually not what the data says. If you stay out, right, you are not going to get the higher return. And so overall, you are probably not going to have higher saving and higher wealth accumulation. So I do think that there is a point in which, you know, we need to push women, in other words, and we need to have them participate in the stock market. They are going to make mistakes, but it's better than not participating. And yet again, it's fearless girl. Right. So, you know, fearless girl, as we have said, you know, even the financial industry understood that, you know, you need to be fearless, because if you are not playing this game, staying out of the game is not going to benefit. And this is a suggestion for all of the women as well. Is it gender and is it just finance? I actually don't think it's just finance. I just, you know, we are trying to do this in other fields. If I ask questions, you know, and if I were asking about roses, right, would women be less likely to say, I do not know, if I weren't asking about, you know, the interest rate in the context of finance? But I do think that there is this kind of women attitude toward you know, doing things or not being 100% sure. There is a book about the confidence code where they interview women which have been in the Marines, okay? Same thing, less confidence than men. And they have chosen to be in the Marines. They even interview Valerie Jarrett. I don't know if you know Valerie, but she was the assistant of Barack Obama. Certainly a super confidence woman. And she admitted that she wasn't as confident as men. So in so many fields, even when women do extraordinary things, they are saying that often they don't have this confidence. And so, you know, there seemed to be something beyond finance, but I do think that in a field which is so focused, which has been considered also so male, then I think the stereotype can become even bigger, and that women can be even more afraid of participating in a field where nobody looks like you.
Yes. Let me ask another question. So you say women participated less in the financial market, but of course they also are less financially literate. So if you take two men and women and they are equally financially literate, do they participate equally in the stock market, or still men participate more? So financial literacy does not 100% explain, if you want, the participation in the stock market.
Right. So it doesn't completely explain. So, and that's why, you know, we are more nuanced. There is certainly a confidence story and so on. So, you know, it's not that you completely can take away this gender difference. Then there can be other things that can be going on, right? And it could be also your beliefs and so on. So, but I think, you know, we have already at least explained quite a bit of this gender difference, but it doesn't explain it all in terms of participation in the stock market.
Okay. And then one other question is the learning effect. So you say you take surveys in May and then you retook them in June or July.
Right.
And in between you took out this don't know answer. Mm-hmm. Now, can it be that people looked up the answer between May and July?
Right. No, it's you know, this question is always asked to us. They don't. You know, these are the general people, and even though, by the way, all of these survey now are done online, right? So people could Google the damn answer, and that's not what people do overall. And I tell you this because even in the US, we have done these surveys, you know, for many, many years. And we don't see this learning effect going on in the sense that, you know, people could be smart and, you know, Googling this answer. You know, when you are, by the way, this survey are done together with, you know, other questions, and people spend about 20 minutes answering questions. They are not going to, you know, spend a lot of time just trying to get the answer correctly. So we don't see this effect, and that's not something to be worried about. Elena, you are muted.
Yes, I'm muted, indeed. I was looking for an answer for a question that I don't find it anymore. There are some questions on how the true financial knowledge is identified in the latent variable approach. How do you separate confidence from knowledge? I don't know if that is a short answer. I pose this question, otherwise maybe if too technical, we postpone.
No, it's a great question. So it's extremely hard to identify. So you are absolutely right to ask this question, the word identify, right? So we had to do a lot to do so. So first of all, you know, we have more information, right? So we have two surveys, one where we allow people to say, I do not know, the other where we take away the do not know answer, and then we ask how confident you are. Okay, so we have already more information that we put in our latent variable model. But you are right that when we estimate this latent variable model, it wouldn't converge. We have to have some identifying restriction and assumption. So some of the assumption we made, and this is actually what I had in one of the slides, so I'll make the slide available and you can see some of these restriction. The restriction is that you cannot be inconsistent in your answer. If you are inconsistent, then you do not know. So let me actually read some of the assumptions. We have made several, and so we force it in a sense. And you know, by forcing this restriction, then we are really better able to identify knowledge and confidence. Okay, so you have to be consistent. You know, if you say in a sense, do not know, and then you answer incorrectly later on, then we assign you to low knowledge, or you don't have the knowledge. So, and you might have true knowledge because you don't, for example, you say do not know in May, but then you gave a correct answer. So, you know, we put a lot of restriction in a sense in the model to say that if people know, they are consistent in their answer, and you know, they are just more likely to choose the do not know if they are not 100% confident. So that's in a sense how we are trying to really identify how much is knowledge and how much is confidence. And with this restriction, I think we are able to identify it. So we, you know, the model in a sense gives us this estimate. and also, as you have seen, I think these estimates are precisely what we get, what we expect, right? We expect that, that the main answer are an underestimate of your knowledge, right? So it's like seeing your classroom and seeing that only three male students have raised their hands and the female student haven't. It doesn't mean that all of the female students do not know, right?
This actually reminds me that I also directly encourage my female students to answer, because indeed, if you ask a general question, they wouldn't raise their hands typically. So
right.
This is to boost confidence in female, also finance students, not just general people. So let me ask, I'm aware that we still have only a few minutes left, but there are two questions that I would really like to pose to you. One refers the potential difference between emerging economies and emerging countries. So your studies are on emerging economies, at least the 4 countries you presented us, and also most of the 15 countries you show us are. But if you have a word on the difference between emerging and emerging. And the second quick question is whether, in terms of policies, you mentioned financial literacy, education, schooling, and so on. But what about central banks? Can they do something to help in this respect?
So these are great questions. Interestingly, when we look at the developing countries, the gender difference is smaller. And it is smaller because men also do not know in those countries, right? So that's, in a sense, while you might think that there is a bigger effect, that is not the case. And I have to be precise here, it's not the case for many countries. But of course, there are countries, for example, of certain religion or certain characteristics where the gender is much higher. For example, the Arab countries. And this is, specific to some of the countries, but overall, that's what we found, that in the emerging countries, the gender difference can be smaller because also we find very, very low level of financial literacy among men and women. Just to give you a sense, in the BRICS countries, the level of financial literacy in our global survey is below 30%. Much, much below 30%. So, in other words, just the population is not financially literate. What's the role of central banks? I actually think there are very important roles of central bank. Let me also tell you that the central bank, the Bank of Italy, is part of the National Committee on Financial Literacy. In many countries, for example, Portugal, the central bank are leading the financial literacy strategies. So often our central bank who are in charge of financial literacy. Why do we think it is so? Is because, probably central bank are very independent institutions who have several objectives. And I think, in particularly in the third objective now, of stability of the financial system, they have understood that it's not just a matter of the system, it's not just a matter of supply of financial instrument, it's also a matter of demand, it's also how individual, for example, participate in the market. And this is certainly due to the previous financial crisis, where we saw that even though there was a lot at stake, for example, people had a lot to lose in engaging in the wrong mortgage, they still engage in the wrong mortgage. And so, lack of financial literacy can have consequences on the stability of the financial markets. So important role, I think, of central bank in promoting financial literacy, because I think a better system where people are more financially literate is a system which is more stable, and is a system where potentially can grow more and better. One of the things we have also seen in the current crisis, that financial literacy acted as a shield, protecting people better against shocks. And I have to say that they can also be important in, central bank are also a little bit the evidence of that man business. It is until very recently that we have seen a woman being president of the European Central Bank. So I want to encourage the central bank in two ways, certainly to continue to play this important role in national strategies and promote financial literacy in school, in the workplace, as a kind of a national strategy, and also promote women. You know, banks are considered precisely finance, are considered, you know, where people, you know, look at when you look at finance. And if you don't see women in banks, in any bank and at every level, then, you know, again, there will be this idea that women do not belong to this field. There will be a disincentive effect for women. And this is really not what we want to do, not only because it's the 21st century, but because everyone should know about finance today is very important, not just for the individual, but for society as well. So we all benefit if women participate in financial markets and in banks.
Thank you very much, Anna. This is the, I mean, I would still have lots of questions and I would love keeping this conversation with you, but I realize it's 2 p.m. so we should interrupt, and I hope we will have other occasion. But let me say also, as the program chair of the European Finance Association for this year conference, I also noticed that there are so few women in finance. I mean, the difficulty of involving people in the female finance expert in the program has been enormous for me. And I really spent a lot of effort trying to, I wouldn't say 50-50 because that was not my objective. There aren't so many, but really to involve a female finance expert in the program. So let me take the occasion also again to thank you for helping in this dimension. And going back to central banks, you're right that we have a president of the European Central Bank, but if you look at the governing council, it's still a desperate situation. So there are 2 female in the entire governing council. So there is not a single female governor in the whole of the euro area. So that is really something that I very much hope in the future we will be able to change. So let me stop here, and we will actually talk on these issues of female in the central banking community later on in the Women Financing Series, perhaps in the fall, because actually the ECB has done a study on this. So we will go back to this issue, which is indeed very important, as you say, as a role model to start with. So let me stop here. Let me thank you very much. We have a lot of congratulations to you for your excellent presentation and discussion. Many people are asking now if we can share the slides. I think we will certainly post the slides. And I would like to ask all the attendees to keep following our activities and the activities of the Center of Annamaria on this particular topic of financial literacy. And thank you again. It has been a real pleasure to have you with us today. Thank you.
Thank you. A real pleasure for me as well to be able to present my work in this audience. And let me remind you, you know, we need a fearless girl across every stock exchange. So I'm going to speak to the president of Borsa Italiana and hope to have an Italian.
He's a colleague of mine, actually.
to have an Italian girl in front of the New York, of the Italian stock exchange, because the gender differences in Italy are particularly large.
Oh, so, yes, I can witness this. Yes, definitely. Yes. That would be, so instead of this statue with the finger, we could have a statue with the fingers.
We could
that
have
would be better. And I hope that very much that we will have an occasion to meet in person soon.
Me too.
Okay, so thank you very much. So also the attendees are really congratulating you, Anna. So thanks a lot, and to the next occasion. Thank you. Bye-bye.